My name is Andrew Levison. I am a partner and the chief investment officer at the Dermot Company. The Dermot Company is a 34-year-old vertically integrated multifamily business focused on the East Coast of the United States. So we define the lifestyle renter as someone who could buy a home, but not necessarily the home that they want. And this is a fast-growing renter population because one, we've had home price appreciation in this country vastly outstrip inflation because we've undersupplied new homes in this country. We have a greatly increasing student loan burden on people coming out of college. And then we've had a change in what people want, what they desire. They're starting their lives later, meaning they're starting to have kids later, they're starting to get married later, and they're thinking about the approach to their lives differently, when to buy a first home or when to have more flexibility. And this is really driving a significant increase in a higher end income renter, not necessarily a renter by choice who can do whatever they want, but someone who has a level of choice, but they can't do anything they want. And so we're seeing that renter population grow very quickly. And we see a lot of opportunities here, not just because it's a growing renter population, but because it's a picky renter. It's a renter who knows what they want, and they want something that is maybe a little bit different than our traditional renters. Their expectations have changed in terms of what they're getting from their landlord. It's not just getting a roof over their heads and working appliances. They also want their apartment community to be their fitness club, their members club, their community base, a place where they can meet people and gather, a place where they can work from home, their co-working space. And so really understanding that customer and being able to fulfill their needs, we think is a huge opportunity in the market. We see residents really looking for something different, something more near term or near to midterm versus long-term thinking. And we think this crosses people in their 20s, 30s, and even 40s today, whereas their parents' generations might have been thinking about buying a first home, building home equity, and maybe upgrading later. The current generation is thinking about living their lives today. What do I want today? Um, that was happening prior to COVID. We think COVID gave it a real boost too, where people sort of had a sense of not knowing what's around the corner, not knowing, how long they were going to be in their current location, in their current job. Some big thing going to change their lives? And that's one piece of it, right? They're saying, well, maybe my life's going to change, so I don't want to necessarily commit to a location and a home. The other thing that happened was there's a significant increase in flexibility in terms of where people work and how they work. And so that flexibility has led people to say, well, maybe I'll rent for longer and I can then move around in different locations, try out different places. Maybe my job is flexible. I can work from home or I can be semi-remote, and therefore, I'm going to be able to move around in a different way. And so we think this is really changing the makeup of the renter population and what they're looking for in their homes. Because of the significant tailwinds that I talked about previously in the lifestyle renter submarket, when we look at the low and middle income tenants, there's a different dynamic at play. Our country has undersupplied housing across the income segment, so there's always going to be a demand for low and moderate income housing, and there are interesting investment opportunities there. But those secular tailwinds that we see in that lifestyle renter segment are much more interesting because it's really driving a population growth in the renter population versus the low and middle income renters who are there. They're going to be there, but they're not really growing because they were much less likely to be homeowners in the first place. And so, those secular tailwinds are what's driving the interest and success in the SFR and BFR space, BTR space. We see similar things happening in the traditional multifamily space, which is where we're focused. So one piece of it is those secular tailwinds. The other is getting into exactly where you invest in these properties because there are a multitude of submarkets and micro markets you can focus on, but really finding where your residents want to be, where that growing demographic is, that becomes much more important when you're focused on this choosy, picky renter population. Migration trends are complex and they're tricky, and we're seeing this play out, now with some of the migration trends that we saw be really strong during COVID and a little thereafter, kind of shifting back a little bit. But we see this overall trend toward high growth urban markets that have great job creation continuing for the long term. So that's, markets like Raleigh and Nashville and Southeast Florida and Tampa, Orlando, all those places that have seen great growth and are continuing to grow and continuing to create really good, six-figure jobs for educated population. So we see those trends continuing, and we are going to continue to lean into those trends for the long term. But this business always comes down to supply and demand. And so these high growth markets where there's lots of job growth, some of them have created a lot of new housing and are continuing to create a lot of new housing. And so we have to be really mindful about where the supply is outstripping the demand. And what we're looking for at Dermot is finding those submarkets and micro markets where there's reasons why there's going to be a medium to long term restriction on new supply. So one place where we've been very active over a long period of time is New York. New York is naturally supply constrained because of the dense urban environment and regulatory picture in the city. And so while the growth in New York is slow, we do see growth in the population, growth in jobs, and very limited new supply. And that we expect to continue for the long term. The same things are true in some of the markets that have high supply. We find submarkets and micro markets where there's restricted supply. And that can be because of NIMBYism, that can be because of structural constraints, that could be geographic. And we've developed a tool in-house to find these locations. We call it Dermot Acquisition Intelligence. It looks at other factors too, but one of the main factors it looks at are the immediate micro market and sub-market supply and demand drivers, and making sure that we expect that those conditions will continue to be there to drive outsized rent growth in the medium and long term.